Now, we've talked before about the all-important topic of cash flow volatility. It's important for a variety of things. First of all, solvency. The base case never kills you, but of course the base case, as we go into the future, never happens. Something other than the base case happens. Scenario 1, scenario 2, etc. And it's the volatility that kills. Volatility of cash flow is also critical in valuation and therefore corporate finance and corporate finance decision making. There's a correlation between risk and return, and by risk we mean volatility risk. We've also identified that not only is volatility critically important, but so is free cash flow. The line in your model that says free cash flow is critical not only for valuation, it's also critical for cash management and the investment rule. So we now come to discuss what is it in a business enterprise that causes cash flow volatility. And no matter what industry sector you are in, there are two things that primarily cause cash flow volatility. And this involves the study of company dynamics. Now, the first thing that causes volatility in a company's cash flow is the volatility of the revenue stream. You don't have to be a rocket scientist to accept that if the top line of the cash flow is volatile, it is going to have an influence on the bottom line of the cash flow, in other words, the free cash flow line. And therefore, in my diagram, I have two otherwise identical companies. They have the identical volatility in their revenue stream. Far more important in identifying what causes cash flow volatility is the nature of the operating cost structure of the business. In this company on the left, if I were to identify that the operating costs are almost entirely fixed in nature, I'm going to caricature it with an absolutely straight line. Very, very few companies have 100% fixed costs. But just let's start off with that hypothesis. You can see that with absolutely fixed costs, then in the economic summer, nearly every dollar of revenue, once you've achieved break-even, goes straight to your bottom line, and your cash flow becomes very large. Conversely, in the economic winter, the loss of virtually every dollar of your revenue stream, all of it comes off your bottom line, and you go severely cash flow negative. And therefore we've identified a risk. And I've illustrated it as if it's an industry cycle, but anything can cause volatility, event volatility. Currency movements, commodity price movements, bottlenecks in your logistics infrastructure, and so on. And therefore the cash flow on the company on the left will be extremely volatile. Conversely, on the company to the right on the diagram, I have depicted that 100% of the operating costs are variable to the output of the business, and therefore the cash flow itself, which is the revenue minus the operating costs, the free cash flow is relatively stable as you flow the gap between the red line and the black line. Now, these are two theoretical extremes. So let's start with these. The one on the right, I call that the Chameleon Dynamic. I call it the Chameleon Dynamic. As you're probably aware, a chameleon camouflages itself to its surroundings. It adapts. A Chameleon Dynamic company adapts to the business environment in which it finds itself. Now, I say is capable of adapting. It doesn't happen automatically. Companies don't exist. Companies are bits of paper in a registry office somewhere. Everything that a company does is done by human beings. And whether you achieve what I've depicted on that diagram depends on the caliber and ability of management to manage that cost structure effectively. What you don't want, in my opinion, managing a chameleon dynamic, are people with MBAs and PhDs and pinstripe suits on the 20th floor of an office tower 5,000 kilometers away from where the business is conducted. Because if you have textbook managers in a company like this, you get reactive management. And of course, if you could imagine that you turn the operating cost taps off after the revenue has turned, in other words, if you position that red line several centimeters to the right, you would realize that you do have actually volatility. What you need running a company like this are people with dirt under their fingernails, their sleeves rolled up. They smell this market. They position the company now for the business conditions they anticipate in 4 or 5 months' time. In other words, they are totally immersed in this business. This is not an academic skill. This is something that you either have or you don't have. I would be lousy at running a business like that. The company on the left, I call a dinosaur dynamic. I call it a dinosaur not because it's extinct. There are plenty of businesses that look like this. I call it a dinosaur because in the economic summer, with all of that surplus cash flow, as the costs are fixed and the revenue is high, you start spewing out cash flow like you wouldn't believe. You're the biggest animal in the jungle. And because markets are cyclical, because you are generating large amounts of free cash flow, you are very attractive to the capital markets. So several bankers a day are coming and offering you funding. You have easy access to the equity markets. And so the management of a dinosaur dynamic in the economic summer can embark on aggressive growth strategies. However, as the economic winter approaches, the cash flow dramatically declines. And you can't avoid it through good management. Unlike the chameleon dynamic that can adapt to the business environment, a dinosaur dynamic cannot. I don't care how well managed you are. If you're let's say Volkswagen and you lose 20% of market demand, you can't avoid it. You will get hit. Your cash flow will become dramatically negative. In the early 1990s, for example, Volkswagen's free cash flow over that down dip in the cycle, the negative cash flow was $4.5 billion. But that's okay. They've been around several decades and they know what it's like when you enter that economic winter. Volkswagen had $17 billion of committed standby banking lines. This is where we do need our MBA, PhD, pinstripe suit types, because the sort of person we need to manage the volatility that is inherent in this dynamic, we need strategic capital management. You see, with the chameleon dynamic, you manage the P&L and the assets. In other words, you manage the business to absorb the volatility. You see, we call it strategic capital management. Strategic because we have to get our capital structure in order at the top of the cycle when we are strong. We think forward, we identify how big that negative cash flow might be for a variety of volatility events. Not only the business cycle itself, but for the SARS epidemic, the coronavirus epidemic, a change of government policy, major shifts in foreign exchange and whatever other risks that or volatilities that you've identified. And having identified and quantified, we then put in place a liquidity safety net to ensure that when we get hit by the volatility, we have a planned capital structure that can absorb it. It's like a circus trapeze artist, swinging through the big top in the circus. If they don't have a safety net, you'll notice they're very young, because if they ever slip, they won't be flying again. We need a safety net that will do the job. We don't want a safety net which is 6 inches above the ground. We don't want a safety net where the bits of rope are more than 2 meters apart. In other words, we have to have a safety net that is designed to do the job. So you identify the risk, you quantify the risk, and then you put in place the measures to manage the risk. Can you think of any business sectors that don't exhibit very much volatility at all? Again, I've caricatured it with an absolutely straight line. If this was an interactive scenario, I'm sure you would probably pick a few. For example, food processing, Nestle, Kraft, and so on. Or supermarkets, Carrefour, Tesco, Sainsbury's. Businesses of this sort have a natural stability in their cash flow. They can always be hit, of course, by extreme events, black swan events and so on. But under normal operating conditions, I would reasonably expect them to have a relatively stable cash flow, and therefore they represent relatively low risk. Now, if we put all companies on a spectrum, from chameleon to dinosaur, and then draw a normal distribution curve, most companies aren't extreme at the extremes. Most companies are bunched toward the middle. Now, as a generalization, companies towards the center of that spectrum tend to be in manufacturing, because approximately half of their operating costs will be things like, let's take an example. Let's imagine a washing machine manufacturing company. About half of your costs will be components and materials. And these are inevitably variable. There may be delay effects, time lags, and so on. But in the macro, they are variable costs. The other costs, things like premises, utility costs, payroll, these are definitely sticky. You may have a slight variability to it, of course, but if I have a 20% drop in demand, I'm not going to get rid of 20% of my workforce and then hire them back again in 12 months' time? I think not. And therefore, manufacturing tends to occupy more towards this centre ground. Down at the chameleon end of the spectrum, it often will depend what jurisdiction you're in. For example, in service industries, where the vast majority, maybe 80% of your operating costs are people related, if you're in a common law jurisdiction, you will be very chameleon-like. In a common law jurisdiction, the state has no right of interference in a private contract between an employer and an employee. If I had 20 people in this room who were working for my company, and we're a service industry, but we've lost 50% of our business, I have some change in government policy, let's say, I can get rid of 50% of these people this afternoon. And the only way the law interferes is how much I have to now pay them to go away. And in the UK, if you're aged between 26 and 41, it's 1 week's pay for every completed year of service. And if you're under 26, It's half a week pay for every completed year of service. By the way, I'm not proud of this. Some states of the US are even more extreme. In other words, we can, should we choose to exercise that power, we can adapt our cost structure very chameleon-like to the business environment that we've now found ourselves in. If, however, you're in a civil law jurisdiction, civil law is based on Roman law, and the guiding principle of Roman law is to regulate rights among citizens. The idea that you can throw people away when you have no further economic use for them is anathema to a civil law system. And you'll have to compromise how many people you lose, you'll have to pay them a lot more, you'll have to negotiate it with their representatives, and you will not be at the chameleon end of the spectrum. In countries, Italy for example, you'll be quite far towards that dinosaur end of the spectrum. In other words, when you are trying to identify the cash flow volatility of a company, you need to forensically research and model the operating cost structure of the business to identify the constraints that you are under for adapting that cost structure, law, contract and culture, and try and pinpoint this very much as part of your due diligence. Just to finish off on this commentary on company dynamics, let me pick up two more. The two straight lines, I call that the turtle dynamic. Yeah, the line in the sand where a turtle has gone is two straight lines. And sometimes the operating cost is uncorrelated to the revenue. In other words, for example, most of your operating costs are commodity based. The price of a commodity has nothing whatsoever to do necessarily with what's happening on your revenue stream. In other words, they are unconnected, which means the costs can be quite erratic. There's no pattern. And I call this the snake dynamic. Now, for a corporate lender, for example, this means the debt capacity is very low. It's unquantifiable. It's not a banker's job to gamble. And it also means in corporate finance, it's high risk. And that means high discount rates when you're doing valuations. So let me summarize what we have covered so far in a slightly different way. We start off with the same two companies, again, left and right. On the dinosaur dynamic, high fixed costs amplify the volatility. Whereas with the chameleon dynamic, high variable costs absorb the volatility. So that down at the bottom, the volatility of the revenue stream, which is the black line, is identical in each case. But the free cash flow, the all-important free cash flow, important for both solvency and valuation, the free cash flow is amplified in the case of the dinosaur dynamic and absorbed in the case of the chameleon dynamic.